Hi everyone! Last week turned out to be rather taxing for traders. It started with an uptrend in the equity market but ended with a rapid drop. All three benchmark stock indices slid into negative territory, snapping their winning streak. The week was also volatile because of the release of crucial economic reports and events. The Fed meeting finally took place. Apart from that, the non-farm payrolls report was also in the spotlight. Investors were unable to find clear hints about the Fed's future plans for monetary policy. New data confused them even more. This is why uncertainty of the future stance persists. On the one hand, the regulator made some dovish hints, saying that it could switch to a 50 basis points rate hike. On the other hand, the central bank confirmed it would remain strongly committed to aggressive tightening for a longer period of time than expected. The NFP report was also rather contradictory. The figure topped analysts' expectations. It means the economy continues to add jobs at a fast pace. However, the unemployment rate increased as well. This week, traders will digest fresh macro stats and the Fed's comments. There is no need to say that they are largely focusing on the inflation report. After its release, several Fed policymakers will deliver speeches. The midterm election and a batch of the US economic reports may also affect market sentiment. Watch this video and find out the latest market news. Let's get cracking. The Fed meeting did not bring any surprises. As widely expected, the regulator raised the rate by 75 basis points and confirmed further sharp rate increases. Interestingly, after the meeting, the tone of the Fed statements was more dovish. Fed Chair Jerome Powell also hinted at the possible slowdown in monetary tightening in December and January. However, the euphoria did not last long. The interest rate could be raised higher. If in September the Fed announced 4.6% as the ceiling for 2023, then there were rumors about 4.8%. Currently, investors expect the Fed to raise rates to 5% or above next year. However, the regulator did not confirm it. This is why stock markets are gripped by uncertainty, as speculators have no idea what to expect next. Perhaps the Fed does not have a clear plan as well. For this reason, it does not want to make loud statements and give false signals. Analysts believe that the CPI report and new comments of Fed officials may shed light on the Fed's future plans. If inflation declines, it will certainly boost dovish expectations. Now the central bank sticks to a hawkish stance. President of the Boston Fed, Susan Collins, was the first to make comments after the November meeting. Collins said that she backs further tightening. However, in her opinion, the pace of tightening could be slower than in the last few months. Collins also pointed to positive signs of a possible slowdown in inflation. Thomas Barkin expressed a similar view, noting that the central bank would need to raise rates above 5%. The Dow Jones snapped a two-week winning streak. Optimism on Wall Street was triggered by increased expectations of a dovish stance and a market reversal. Last week, the Dow fell by 1.8%. The drop could have been even deeper, but the index managed to perform a small upward correction on Friday. The US stock indices rose on Friday after a mixed NFP report. The Dow Jones gained 1% and the S&P and NASDAQ indices climbed by about 1.2% each. In October, new jobs surged more than anticipated, but unemployment also grew higher. It renewed hopes about a possible shift to a softer stance. It appears speculators tend to believe that the regulator will slowly but surely begin to move away from monetary tightening. If their expectations turned out to be groundless, they will have to face the brutal truth again. As for the labor market, it remains strong despite high interest rates. Powell mentioned it during his speech at the press conference. It's definitely a hawkish signal. Judging by the dynamic of all the key stock indices, there are some signs of a reversal as well. Risk assets won back their losses in October after a two-month decline. Overall, they grew by 14%, while the US dollar index lost momentum. The seasonality factor also impacted the stock market. October and November have been fairly strong periods of the past 10 years, so stocks are growing steadily at this time. This year they also managed to advance. However, November is unlikely to be as profitable as the past 2 months. Stock indices may try to consolidate at the highs reached in October. The S&P 500 index lost 3.6% last week. On Monday, despite a bad start, all three indices were able to return to the green zone. The index is located above a strong support level of 3,730. This level could help the index resume an upward movement in the future. This week, the main catalyst will be the midterm election and inflation data. It remains to be seen whether a rally will revive or it will be a short-term upswing that occurs in the bear market. Oftentimes, midterm elections have a weak impact on stocks. Investors are more focused on the economic reports, especially after the Fed announced that it would analyze incoming data before making further monetary decisions. Therefore, inflation figures are sure to significantly influence market sentiment. However, the market situation is unusual now, hence everything may be different. It is possible that investors will pay more attention to the midterm election. If the Democrats win, traders may fear that the Congress under their control will continue to increase budget spending, fueling inflationary pressure. However, according to polls, Republicans received more votes in the midterm election race. As a result, they may obtain an equal number of seats with the Democrats. Speaking about the recent rally, one should not take it seriously. It does not look like a trend reversal, but a correction in the bear market. Such sharp swings occur due to possible changes in the Fed's monetary policy. This year, the S&P 500 has made reversals 5 times. Fluctuations within a month could have been 7% or more amid upward and downward movements. The last time it happened was in 2008 crisis, and before that in 1933. Naturally, analysts do not rule out a market reversion. The bulls may be accumulating strength. However, it will happen not so soon. There are no signs of a bottom, but there is a signal of a resumption of the downtrend. The S&P looks overbought. There could be a drop after the publication of CPI data. Investors should not forget that even with a decrease in inflation, the reading will be much higher than the Fed's target level. If so, it will be another solid argument for the Fed to stick to a hawkish stance, especially after it fails to considerably push inflation down this year. In case of a steep pullback, the S&P is projected to decline below 3,730 again. Then another test of the 3,620 level may take place. The resistance level is located at 3,802. At the same time, the strong resistance zone is now seen at 3,890, 3,900. The NASDAQ 100 logged the largest weekly drop amongst the stock indices. It slid down by 6.3% after a 2-week steady growth. Analysts believe that it was a corrective rebound. Despite significant weekly losses, the index managed to settle at 10,000. The prospects of the tech sector are quite grim, as well as the economic ones in the United States, as recession seems inevitable, as the Fed may trigger it by raising the rates higher to tame inflation. Over the past 6 decades, a recession has followed every time when inflation exceeded 5%. Earlier, Jerome Powell pointed out that a soft landing would be very difficult. Apple shares slipped by 1%. The company expects to produce at least 3 million fewer iPhone 14 handsets this year than planned, following a significant production cut in a virus-blighted plant in China. Many workers fled to the site after the coronavirus outbreak. Thousands of workers are forced into quarantine. Meta platform's stock jumped by 3% despite a warning about layoffs starting this week. Pfizer shares may collapse to $30 if the coronavirus eases. Sales of the drug and vaccines will provide 52% of the company's revenue in the last quarter will fall. The company plans to offset these losses by selling new pharmaceutical inventions. Apparently, investors do not believe in the success of the new strategy. Peloton may face the same fate. Its shares showed staggering growth during the pandemic. However, now they are rapidly depreciating. Since the start of the year, its shares have sunk by more than 70%. After reaching a high in early 2021, its losses amounted to 94%. The situation will hardly improve. The manufacturer of fitness equipment revealed a downbeat earnings report for September. The losses were almost twice the forecast reading. Sales decreased by 23%. Peloton also shocked investors with pessimistic forecasts for the holiday season. The company said it would try to boost production, but how? It also has to deal with unfavorable macroeconomic conditions, including rate hikes, soaring inflation, and recession fears. Aggressive tightening usually puts pressure on tech stocks, posing a threat to the long-term earnings of such companies. Peloton seems to be unable to win luster with investors. The prospects of the company will be clear in the coming months. Perhaps its shares will fall to the lowest levels on record. That's all for now. Subscribe to our channel and stay up to date with the latest market news. See you.